Corey, stretched to the point of breaking. When is that point?
Well, it certainly appears to be on the precipice of arriving. So we look at savings rates and we look at revolving credit balances, and revolving credit balances are expanding at a historically high rate, up 15% in the last month, whereas savings rates, which pre-pandemic, the trailing 12-month average was closer to 9%, it's now closer to about 2%. So people aren't saving as much, and they're spending more on credit. What does that mean? Well, we tend to favor those retailers that are value-oriented and sell a lot of food because, frankly, consumers are stretched with inflation running at 8% through the first 11 months of this year and gas prices above $3 a gallon USD.
So I also saw a stat this week over the last couple of days that a lot of consumers are tapping into their 401ks, those redemptions, just at a rate higher than we've seen since Vanguard has been tracking that. But it's one thing to talk about the consumer just in aggregate. There are different consumers with different financial profiles who are weathering this time differently. Is this just a continuing story of the divide between that working class Walmart shopper that's more affected by inflation and then the higher end luxury consumer who's less affected?
It's a great question. And we've certainly seen a bifurcation between higher income consumers and the retailers that cater to that customer, and lower income consumers and the retailers that cater to that customer. While both are clearly pressured, the lower income consumer has continued to be a little bit more pressured as it relates to discretionary spending, and the retailers that cater to that customer have suffered as well. So couple that with elevated inventories and markdowns, it's been a relatively rough time for a lot of these retailers. But one of the things that is perhaps a little unique to a retailer like Walmart is that it's gaining a lot of share. And it's not just gaining share from lower income customers like you would have thought. 3/4 of Walmart's share gains are actually coming from higher income customers that are trading down into the retailer. Same with Dollar General. Dollar General, the average customer earns about $35,000 a year. But Dollar General is seeing a customer, that earns $100,000 trade down into the retailer. That's roughly 3x the average customer. So it's clear that it's not just the lower income customer that's feeling the pain right now.
All of that, Corey, comes as Walmart is looking at this entry into the buy now, pay later space. What does that tell you? And is it something that could actually increase the fragility of their customer base in the longer run?
Well, I think this is just an extension of Walmart's personal finance initiative. It started in January of 2021 when Walmart launched an investment firm. The company then, within the next 12 months, acquired 2 firms to help build that out. And then in April of 22, the company hired John David Rainey to become CFO, and he's a former PayPal executive. And if there's one person who knows a lot about payments and to help facilitate the personal finance arm and the growth of that within Walmart, I think it's him.